go. All right, go to the chat. There we go. All right. Get started here in just a second. All righty. All right. For anyone who's there, I'm going to wait and see if some people join. Just give it a minute here. I managed to successfully blow up the live stream prior to starting, but we'll get started in just a second here. All right, so I'm going to get started here in just a second, guys. Just trying to let people join. I managed to blow up the live stream link right before we started, so apologies for that. But we will get started in just a minute or so here. We're just letting some other folks join. Cool. All right, I'm going to go ahead and kick this off here then. So welcome everyone to our first of hopefully many live events for Financeable. I'm Mike, the founder of Financeable, and the session that we're going to go through here is how to value any business. We're going to do a whole series of these. If I can make it happen, I think every week we'll do a session where we'll go through either a chat with someone in the industry or go through just a quick teach-in on really critical topics in finance. This week, we're talking about valuation, and so that's going to be our focus here. But looking, like I said, to do a lot of these and have a little bit of fun with this. So with that said, I'm going to jump right in. And if there's a chat here, so I can see people can send in messages in the chat. If you have questions, please do fire them over. Happy to answer any questions you guys have as we go through this. So we're going to kick this off with talking about what you're going to learn after this as you learn as a part of the session and learn all the bits and pieces, what you'll walk away with when you finish the session. So the first thing is you're going to get a high level framework for valuing any business. So give you kind of a big picture view of how to value a business. We'll also talk about asset versus cash flow valuations, how to think about valuing the assets versus the cash flow of a business, the 3 common valuation methods, and then how all of this ties together if you're looking to go into investment banking. So a lot of folks on the video are aiming for IB. So I wanted to just tie it into kind of how you would apply this. But I should note that this isn't just an investment banking conversation. This is really valuation is central to owning a business, to private equity, to venture capital, hedge funds, no matter what. But just given the concentration of IB focused folks in the audience, we'll talk about that. But it really applies to everything. So with that said, I'm going to jump ahead here. My slides seem to want to jump ahead on their own. I'm not sure what is going on here with this, but we'll work with it today. So the thing I want to think about here is kind of what the first step is in building a house, and use this to kind of frame the discussion around how to think about building into. I'm sorry, my PowerPoint is acting up. It's been a technical snafu day. Bear with me 1 second here. All of a sudden these timings. There we go. Hopefully that's resolved. The day of technical snafus here. Let's see if that holds. So the question is kind of what's the first step in building a house? And the reason I'm asking this question is I want to kind of frame how Financeable approaches training relative to some other things that you may have seen that are out there in terms of just different approaches to teaching. And everyone has their own way, but sort of our approach is similar to building a house. So as you're thinking about building out mental frameworks for anything, whether it's finance, mathematics, or whatever the case may be, the first step, as you would probably guess, would be building the foundation. You want to have a strong foundation whenever you're building out anything, particularly a mental framework. And we want to make sure we get the core down and pin that down well. And that's what we're talking about here. So we're really focusing, when we talk about valuing a business, on the kind of high level view of how to go about this at a very kind of 10,000 foot perspective, so that you really have that underpinning when you go into more complicated topics. So the reason I bring this up is a lot of trainings will throw you kind of right into much more complicated things, or maybe you're an eager student and you want to dive into like financial modeling or something that's a little deeper, maybe LBO modeling. And what I always encourage folks to do is really pin down the core foundation first before you dive into the more complicated things, because it will help you. It kind of provides that framework, that lattice work to really expand. And so that's what we're going to again focus on here. So if you don't do that, you are very likely to end up with a broken foundation and kind of a broken situation. With that said, one other quick comment on kind of our approach to teaching and how we kind of look at the world. So we really want to have not just a strong foundation, but a very clean foundation intellectually and conceptually. And think of it as kind of like your office. So if you have a messy office and there's stuff everywhere, and this would be the equivalent of just kind of learning everything about finance at once and trying to like absorb it all in one day or one go, it becomes kind of a mess. And what we're really trying to do, and you'll see this kind of throughout this course or any of our courses, is build a clean foundation. We want everything to be very clean at the beginning so that we can work with that and keep everything in one place and really understand how everything fits together before we go into the more complicated. And again, that's what we're going to do here. And you'll see this kind of permeate all of our particular conceptual, kind of the first few major modules for Financeable. So we got to keep it simple, got to keep it clean. You're going to see that throughout. And I just want to clarify both the foundation, really pinning that down, and also keeping it clean before we dive in, because as I said, this is probably a little different than some of the other things you've seen. So with that said, I'm going to hop ahead here and talk about actually an extension of that exact point as it relates to finance. So I want to just distill finance as a whole down into something that's a lot more sort of straightforward and simple. And at the end of the day, to that point, there are really just three questions in finance. There are three big questions that are at the root of virtually any question that's asked in finance or of any exercise in finance. And those three questions are, what's the cash flow? So how much cash does this business generate? How much cash comes out of the business? What is the asset worth? What is the item that we're looking at worth? And then what's our return? And there are a million different analyses that can stem from these three questions, but these three things are really the root of all of finance. And these are all things that we're going to attack in our concept series of Financeable and just kind of dig into. And in particular for this module, we're looking at what is it worth and really trying to understand how we value a business as a whole. So that's the aim here. We're talking about valuation. And with that, I'm just going to jump right in. So just double check, make sure I'm not, okay. We're not getting messages here. So this is actually the first section of our valuation course, which we'll be releasing early next week. So you get a little bit of a sneak preview here. But this is really the beginning of our valuation course. And to that point, we are going to imagine that we are an investment banker and we are working with a CEO who runs a company called Gooey Cookies, because let's keep it fun and cookies. I mean, who doesn't like cookies? So we're going to work with cookies here. So we have a CEO who runs a cookie business, and they've hired us to figure out what their business is worth. And as I said, this is kind of one of the three root questions that you're going to ask in any financial analysis, or any kind of broadly any financial analysis, is like, what's the business worth? And that's what we're going to explore there. And if you haven't ever gone through this exercise before, I'd strongly encourage you to take a second and just give that some thought. If you were running a business and you're thinking about what's it worth, kind of what would you think? How would you approach that? What sorts of analyses might you do to think about what a business is worth? If you're the CEO of the company, how would you think about that? So I'm going to pause for just a second, let you guys ponder that. Check over here, and then we'll carry on. Okay, so with that question posed, let's jump ahead here. So to frame this entire discussion, we're going to use a house as an analog for a business. So houses and businesses are actually the same thing. We don't think about a house as a business because we live in a house. We usually live in houses. We don't think of them as something where we're going to make money off of them. But if you step out of a house and you rent it out, it very quickly becomes a business. It generates cash flow just like a business. And so we're going to kind of use houses and businesses interchangeably in this particular session, and also kind of across the board with the Financeable courses. You'll see this kind of permeates all the courses. So a house is a business is a house is the first thing. And I want you to imagine that you're analyzing or valuing two different houses. We have one house that's in the country. Let's imagine the middle. I'm actually from the middle of Pennsylvania, lots of cornfields. Let's use that as the example. A house that's in the middle of PA that is on a certain size plot of land and that has a certain size to it. So it's, let's say, 2,000 square feet on a quarter acre sitting in the middle of Pennsylvania. And then we're going to imagine that same exact house sitting in, let's say, San Francisco. Same exact size plot of land, same exact house. And the question to consider here is, which house is worth more? So which house of these two, again, same exact building materials, same exact plot of land, which one is worth more? And much more importantly, why is one worth more than the other? So I'm going to ask you to press pause and kind of give it some thought for a second. If you want to take guesses, pop it in the chat here, and give me a guess. But if not, we'll just press pause here and let you think about it. Okay, so hop ahead here. Not a trick question here. So I think most people, when they hear this question, it's sort of like, okay, how could it not be the city house, right? If San Francisco is worth more, clearly San Francisco real estate is very expensive. So the answer has to be the city house. But the real important thing to understand here is why that's the case. And I'm still kind of figuring out the live stream talking. Oh, city house, got a vote in here. So thank you, Jacob. So, actually, okay, we're getting some votes here. I'm going to use, apologies. I'm going to use the polling device. Actually, let's actually No, I already gave the answer. So we'll do it the next time around. So city house, right? So it's going to be a city house, right? So, okay, consensus view. Question for the group, and I see some comments coming in here. Question for the group, why? Anyone want to take a guess as to why? I think the intuitive response is it's got to be the city house. Why is that the case? Any guesses? Okay, this is where it starts. So Eric here says, city house because the demand is greater. Going down the right path, demand is greater. But what does demand create? Demand exceeds supply. That's also right. That's 100% right. But what does demand exceed? Okay, location. So demand is higher. Correct. We're going on the right path. If I own an asset where demand exceeds supply, price of living is higher. 100% right. What happens as the owner of the asset? What do I get as a result? Access to more higher demand. Okay, we're going on the right path here still. Let me see if anyone, I'm going to give it a second, see if anyone gets a little further. I'm looking for a more specific answer. The value of the houses. Okay, all the houses. Daniel, that's the answer. So the answer here is the rent is higher. That's why. The demand is the driver, right? But the reason the city house is worth more is because the owner of that house can charge more rent and thus generate more cash flow. So when we go and buy a house, for example, so if anyone here has ever purchased a house, or your parents have purchased a house, what you're really doing, and this is jumping ahead a little bit here, is you're actually doing a discounted cash flow analysis. You just don't think of it that way because you say, oh, well, the house is worth X 100,000 or however much it's worth dollars because that's what someone says it's worth. But implicitly, the underlying driver of that value is ultimately the rent or cash flow that you could extract from that asset. And that's ultimately what's driving the value of the house. So whether it's a country house or a city house, what's going to determine the value of the asset is not the physical bricks and sticks, so to speak. It's really going to be the rent that you can extract. And that's ultimately what drives value. So for a house and ultimately for a business, cash flow is the root of valuation. So when we think about valuing any asset, cash flow, virtually any asset, and I'll explain why virtually in a second, virtually any asset, ultimately the underlying driver of that value is cash flow. And again, if I buy a business, it's because of cash flow. If I buy a house, it's because of cash flow. And it's ultimately what cash flow can that asset generate? I think I've beat that horse dead, so I'm going to jump to the next slide here. I think you guys are getting the idea. So let's say that not everyone on this live stream may agree with me, by the way. And let's take that as a point here. So you might say, okay, well, that sounds interesting. You sound like you're pretty confident in what you're saying, but how do I know? And in fact, the CEO has actually come back with a similar question. The CEO says, okay, well, we come back to CEO and say, look, it's cash flow. Exactly what I just told you. The CEO comes back and says, hey, wait a minute. Like I run this business. I have a store. I have inventory. I have all sorts of things in this business. How is that not the value? So I want you to actually just ponder that question for a second and think about what the right value is for a business. Because I just told you it's cash flow, right? On the one hand, but on the other hand, you own a bunch of things. You own a bunch of assets, and those also have value to them. So there isn't really a question for you to answer here so much as to think about why you might think about one versus the other. So just 20 seconds for thought, and then we'll carry on here. I think I'm slowly getting down the live stream thing. All it took was a double shot espresso here. All right, so let's carry on here. So here's how to think about it. So in a sense, there are kind of two valuations for any business and ultimately really any asset. There's asset value to begin with. So if we run a business, we could remove the employees and then sell off all the physical assets, right? And that would get us some value. And as you'll see in a second, as it says here, that's going to be a lower value in most cases. And I'll explain why in a second. Or alternatively, we could take those assets, we could hire some employees, right? Hire the employees back. And that business will generate cash flow into the future. And in a sense, that's kind of the goal of business. The goal of business at a root level is to assemble assets and create something that's worth more than those assets, right? The value of Google isn't its buildings, right? The value of Google is the money it makes from search. The value of Amazon is not the value of its trucks. It's the value it makes from selling things around the world. So the assets are valuable, but really the whole goal of business is to put assets together and create something that's worth more. And ultimately, that's what drives the cash flow value, and that's what the value will be of the business. To that point, you could have a situation, though, where the asset value is greater than the cash flow value, and that's what we're going to talk about next. So just jump ahead here. So the short story and kind of punchline following up on the prior slide is, excuse me, you really have two potential scenarios here. So in most cases, if a business is doing well and it's generating cash flow and it's moving along, the cash flow value is probably going to be worth more than the asset value. And in that case, what we're going to do is use cash flow value. Excuse me. Cash flow value. So ultimately, cash flow value is what's going to drive the valuation at a root level for the vast majority of businesses that you come across. However, in some situations, the asset value will exceed the cash flow value, and then you kind of default to the lower of the two in that case. So in that case, the asset value would win out. So let's imagine, and I'm not picking on department stores here, but let's imagine you're running a department store right now, and you have a bunch of mall assets. The real estate might be valuable in and of itself, but let's say you're renting, just to keep it simple. Let's say you're renting mall real estate. Well, you have some assets in that store that are worth something, but the cash flow values are weaker, and so they're probably lower than the asset value. And again, not picking on department stores, but just with a business that's experiencing struggles like that are secular, you have this kind of dynamic of the assets are often greater than the cash flow. So short story here is really you're going to pick the greater of the two, but in most cases, cash flow is the root driver, and that's ultimately what we care about. And I'm going to actually tie that back to what we talked about, with the real estate or the house example that we talked about earlier. So if we think about a city house and a country house, what I said was it's the same asset, same size land, same size house, everything. The asset value is down here, right? But for the city house, it's much higher. And the reason it's much higher is ultimately the cash flow you can extract from it. So hopefully that makes a little more sense now. I should mention before I jump ahead, if you guys have questions, please pop them in the chat. I'm happy to answer any questions you guys have. This is fun. I'm excited. Having a good time here. So with that said, let's jump ahead here. So now we are going to move ahead, and we understand the idea that cash flow is how we need to value the business. So we go back to the CEO and say, all right, we're gonna go value your business, and the problem is we don't know how to do that. So you're now in the situation where any sort of budding analyst will end up at some point, which is, I've said I'm going to do something. I now need to figure out how the heck I'm going to do it. We don't know how to value business. So we have to figure that out. And that's where we're going to go next. And to help us, we have someone who knows the ropes and is going to show us the ropes as we work through this. So we have to work through now how to value a business now that we understand that it's cash flow driven. And that's where we're going to head. So in short, and this is for anyone who's preparing for interviews, this is a great thing to memorize here. So there are three main methods of valuation that you're going to use, particularly in investment banking, but this ultimately applies across really any financial valuation exercise. So there are three core approaches to valuation. The first approach is discounted cash flow analysis. And we're going to talk about each of these in a second. But as I said, cash flow is the root of virtually all value for businesses. And so what we're going to do is we're going to try to figure out what the value is of the future cash flows of a business. That's the first approach. Excuse me. The second approach is trading comparables. With trading comparables, we'll go back to a business example here. Let's imagine we're looking at gooey cookies as opposed to a house. We would then go look at publicly traded companies that look like gooey cookies. And we'll talk about what I mean by look like, because it's a little bit more nuanced than they also sell cookies. But short story is we need some publicly traded peers to ultimately help us figure out how to value this company. And what we'll do is we'll look at their valuations and use their valuations to infer what our company should also be worth. And then finally, you have what's called precedent transaction comparables, where we look at how companies, again, we'll stick with gooey cookies here, the business, how companies like gooey cookies have been valued in the past. So we're going to say, okay, well, what similar companies have been sold and what were the valuations for those companies and what does that imply about our valuation? And these are the first thing to note here is these are the three methods of valuation. The second thing to note here is that there are three approaches, right? So there isn't a single approach. And you'll hear this term across finance, which is that you triangulate to value. And in most cases, particularly in banking, when you're valuing a business, you don't say, oh, it's worth X. What you do is you look at what the discounted cash flow analysis tells us, what the trading comparables analysis tells us, what the precedent comparables analysis tells us. And then you triangulate, use those three to kind of guide you to where the business should be valued. And we'll talk about how you do that in a little bit more detail here. And ultimately, we go way deeper in the weeds in the main course, again, that we're releasing early next week. With that said, I'm going to jump ahead here now that we've outlined the three main methods. And missed my last animation there. We triangulate the value. Sorry. I'm going to jump ahead here. So let's talk about this discounted cash flow analysis. It sounds complicated. It sounds fancy. And at the end of the day, it's really not that complicated or fancy. The short story is, as we said, businesses generate cash out in the future. And we need to figure out what that cash is worth. The problem is that cash is sitting into the future. So what we do is we take future dollars and we pull them back to today. And the process that we follow to do that, and I'll explain this in more detail in a second, is called discounting. And what we're effectively doing is pulling future dollars back to today and saying, okay, what is the price of those dollars today? Or said differently, what is the purchase price of those dollars today? Or said differently, what is the purchase price of the business? So if I have a business that will generate cash flow out of the future, and I take all their cash flows and pull them back to today, what I'm effectively saying is, okay, here's what I pay for the cash flows, which is the same as what would I pay for the business. So what we're really calculating here with this discounted cash flow analysis is just really what's the business worth by valuing the future cash flows, again, as opposed to the assets. So with that said, just to summarize before we jump ahead, we discount cash flows, get to the purchase price. And again, the whole reason we're doing this is these cash flows sit in the future. And as we'll talk about in a second, there's a cost to having cash flows received in the future as opposed to today. So with that said, I'm going to hop ahead here again and talk about this discounting thing. So again, discounting sounds like a pretty fancy thing. We're going to kind of pull it back down to earth here. So let's imagine that you have $100 today to kind of explain discounting, and you could generate a 10% return on that $100. If that were the case, you'd probably agree with me that in a year you'd have $110. And the way we would represent that mathematically is we would take the $100 and we'd move it into the future by multiplying by 1 plus 0.1 or 10%. We would call that compounding, particularly if you did it for multiple periods. The key thing to understand here, and the key really core takeaway from this particular slide, is that money received in the future is actually worth less to us, because if I had received this $100 at the end of year one, I wouldn't have been able to generate that return. So there's a real cost to not receiving money today and instead receiving it in the future. So the short story is when we talk about future dollars, being worth less, the reason they're worth less is because you miss out on this return opportunity. The other thing to note related to that is we can actually flip the math. So we multiply by 1 plus 10%, but alternatively, what we can do is take the future dollars and divide by 1 plus 10%. So just dividing instead of multiplying. And we can take a future set of dollars, in this case, it was $110, and pull them back to today and value those dollars as if we receive them today. So what we're saying is, well, if I have $110 in the future and I could have generated a 10% return, that's actually worth $100 to me today, because I have to account for that cost of missing out on the potential return. The formal term for what we just described beyond discounting, the more macro level term, is the time value of money. But the big point to take away here is that future dollars are worth less than dollars received today. And much more importantly, that when we see dollars out in the future, we have to pull them back with some kind of cost attached to them to reflect that missed return opportunity. And so that's how we value future dollars kind of at a summary level. Again, I'm going to stop there. Any questions? Happy to answer any questions you guys have. Okay. All right. So we're going to wrap all this together and just kind of give a visual overview of what a discounted cash flow analysis looks like. And as I do this, I want you to pay super close attention to the, I'm actually going to increase the size of the screen here, just to make this clear. Move myself down a little bit for a sec. I want you to pay attention to the dollars as we move further and further out in time. So I said we divide by 1 plus whatever the cost is in each period. And I should note, it's covered in our main course. We unfortunately just don't have time to cover it here. But as you go further and further out in time, you'd have to divide by 1 plus that cost raised to different years. So it'd be raised to the second, raised to the third, raised to the fourth. So as you go out further in time, basically that cost is getting bigger and bigger and bigger. So that's what you're going to see here. And I want you to pay super close attention to the size of the dollars as we pull them back. And ultimately what you're going to see is this ultimately arrives at the value of the business. So Clifford, that's a good question here. So how are you determining, this is a great question. How are you determining the percentage which you are multiplying or dividing by? So first answer to that, Clifford, is I picked 10% because it's an easy number. For this, we're doing just an intro here. And wanted to use something simple. The slightly longer answer is that percentage is a reflection of the riskiness of the cash flows. So to step back for a second, if I were valuing the cash flows of a startup, right? So an early stage startup, right? I'm going to use a much higher number. I'm not going to give a specific number, but a much higher number, right? If I'm valuing Kellogg's, right, it's going to be a much lower number. So directionally, the percentage comes from the riskiness of the cash flow stream that you're valuing. That's kind of the simplest answer I can give you. And the term for that percentage is a discount rate. So we call it a discount rate. And what we're really saying is like, what's the cost of that cash flow stream? More risk, higher cost, lower risk, lower cost. In the main course, again, which we're putting out next week, we kind of walk through it. The more formal term, and it's a longer conversation, is the weighted average cost of capital. And what really we're showing there is the blended cost of all the capital providers. It's a longer conversation, but it's going to be in the main course. And that is really what captures that percentage. But it's a little bit longer conversation. If I could point the group to one thing, though, that's worth mentioning related to this, if you did want to dig into a little bit more, I have an article on the site. If you go to the site, there's the Analyst Starter Kit link. And this is all free. And you'll go down to the bottom. There's common interview questions, and it's walk me through DCF. It's actually our highest traffic article. If you go down probably 2/3 of the way through that article, you'll find a whole discussion on weighted average cost of capital that goes into that in more detail. And then ultimately the course covers it in more detail. So hopefully that gives a little bit more clarity. But the stepping back from all the weeds now, the gist of it is higher discount rate when there's higher risk, lower discount rate when there's lower risk. And that's kind of the punchline. And if you want to follow that up, I'm happy to keep going. If there's another question, or if there are any other questions, happy to answer this as well. So I'll pause for just a sec. All right, so I'm going to jump in here. So we're going to do this discounted cash flow analysis. We're going to pull these cash flows back. So I'm going to start here by getting rid of the business, and we're going to look at the cash flow value. And we're going to divide each of these cash flows by 1 plus, we're going to call it R. It's the more formal term for that percentage that we saw before. But we're going to pull these cash flows back to today. And if you go further and further out in time, what you're going to see is these dollars get smaller and smaller and smaller. And as you'll see in the main course, if you take that or really any discounted cash flow course, you're going to see that there's actually some simplifications we make to handle everything out beyond usually 5 to 10 years, because the values are much more straightforward, usually beyond 5 to 10 years. But longer conversation, more for the main course. With that said, when we pull these dollars back, we're going to arrive at some dollar value. And as I was saying, what that dollar value really represents is the price you pay for the cash flows of that business, which is just a different way of saying the price you'd pay for the business. Now, in the business world, we use fancy terms. We don't settle for non-fancy terms. So we don't call it purchase price. We call it enterprise value, or the value of the enterprise, also called EV, which is the same thing as the purchase price of a house. So if you go buy a house, you're paying the enterprise value of a house to buy that house. It's just that we use enterprise value in the business world, purchase price, when you're buying a house, or list price. Let me move the screen back here real quick. 1 sec, so I'm not overlapping with the slide. But that's really the idea of discounted cash flow analysis, is taking these cash flows, pulling them back by that rate, again, which reflects the riskiness of the cash flow stream, and coming up with some value. And that's what you would pay for the business. And whether you do this explicitly or implicitly, this is kind of how every business is valued at a root level. We're going to imagine that we've gone through all the work, have figured out the projections for this business, have discounted the cash flows back. And when we do that, we arrive at a value. And you have to go to the main course to see how all this comes together. It's a longer conversation. But the gist of it is we take all those cash flows, we value them, and let's imagine that we come up with a value of, we're going to round here, $320 to $420 million. That's our first value. And now we can move on to the second valuation approach, which is trading comparables. So we're going to go look at trading comparables. As I said, we're looking at publicly traded peers. I'm going to keep it simple here and just give you the peers. But I want you to tell me what the appropriate peers are. And since we're getting some responses here, we're going to try a Slido. So bear with me 1 sec. Give you guys a chance to, actually, I'm going to kill the screen here. Give me 20 seconds here. I can pop this up. It's a little more interactive. Okay. My big challenge here is doing this without breaking the live stream again. There we go. So I've got a, actually, I can't do that. 1 second. I actually have to take the PowerPoint down to do this the right way. Okay. So, and actually I'll start with the slide and then we'll go to the poll. So we're going to imagine that we have a set of peers for gooey cookies. can actually go back to full screen here. We've got a set of peers for gooey cookies: Crunchy Cookie Co., Chocolate Cookie Co., Cookie Distro, Macadamia, Cookie Soft, Oatmeal Cookie. And we need to find publicly traded peers. Now, we're going to assume that I've done the work for you here. I found out what their revenues are, what their revenue growth rates are, what the profit margin is of the business. And what we're trying to find is 3 peers for our company, which is Gooey Cookies. And now I'll pop this back down, and we're going to move it over to the right-hand side, and we're going to put up the Slido again. And you can open up, let's see if we can get some people to participate here. You can open up the Slido, the poll here, by scanning the QR code. And if you scan it, you'll be able to rank the trading comps. And so we'd love to see if we get some ranks here. I don't know if we'll get any, but let's try. And the goal here is to tell me which, oh, I just killed it, didn't I? Sorry, I'm still learning how to do this. All right, I promise I'll do better on the next one. All right, you guys already got it. Next time, wow, first live stream, guys. Still learning here. But you guys had it right. But let's step back from the numbers that you picked here. When you pick a comp, you're going to look for a company that's clearly in the same industry or does something similar. But the deeper root level point that is missed by so many analysts that I've worked with over time is that it's not just about picking a company that's in the same industry. It's about finding peers that look like this company. And if you go through, the analysis that we ultimately go through with comps analysis, what you're really trying to find here is a company that in substance looks like this company. So I want to ask you guys, so we already picked the peers. So, because I kind of blew that one up, but we said Crunchy Cookie's not a peer. Chocolate Cookie is a peer. Cookie Distro not a peer. Macadamia is. Cookie Soft, Oatmeal Cookie. I'd like you to look at these cookie company related things. And I'm actually curious. What do you guys think? Let's actually pick Crunchy Cookie because the other one's maybe a little too obvious. What do you guys think Crunchy Cookie does? If you had to guess what kind of business that is relative to Gooey Cookies. So just for some additional hints here. So Gooey Cookies, about 100 million in revenue, 12% revenue growth rate, and 34% profit margin. So for every dollar of sales, they get 34 cents of profit. With Crunchy Cookie, it's 800 million. So it's larger. We know that, but it's 20% growth rate annually and a 12% profit margin. And the numbers tell a story. So I guess a different way of asking the question is, what story do these numbers tell you? What does Crunchy Cookie do? If you had to guess, there are probably 5 answers. This isn't a single answer. No guesses. We lost interest after everyone got the poll right. Okay. So I'm just gonna answer this one and work through each of these. So Crunchy Cookie, the way I designed this is more of like a commodity cookie company. So they sell the private label non-branded, where if you look at the profit margin of Gooey Cookies, it's clearly like some sort of branded business. So meaning they're making a higher profit margin. And the reason I'm having us go through this is the numbers that you see for any company: manufacturer, cheaper. Oh, got some answers here. Cheaper cookies, manufacturer. That's exactly right. So when you look at the numbers of a company, the thing to understand is those numbers are an output of people doing something, customers and the employees doing something somewhere, and they tell a story. And the key thing to understand with the numbers is like, what story are they telling us? If I look at Crunchy Cookie, this is growing faster. So maybe this is a manufacturer and wholesaler. That could be another answer to this. So we have a large player growing faster with lower margins. This is a fundamentally different business than a business that's growing slower and has much higher margins. Cookie distribution company, you could probably guess it's a distribution company. Distribution companies typically have lower margins. Now, that's not to say that all distribution companies have lower margins and not all low margin companies are distribution companies. But the thing to understand is when you see numbers that have big variances, that's probably not a company that's like our peer. And the key thing to understand is why they're different, and then either discard them or include them if they're relevant for one reason or another. Same thing with Cookie Soft. I'm just jumping to the ones that are the no's here because the other ones are pretty similar. Cookie Soft growing super fast, right? Super high margin. This is a software business, right? And again, not all high margin businesses are software companies and vice versa, but it's a different business. And the key thing to understand here is not that you're just looking for companies that are in the same industry, but that are really fundamentally similar to our business. So I think I've made that point hopefully pretty clear at this point. I will just carry on, but ultimately these are going to be our peers. And what we do is we identify the peers to begin with, as we did here. And we are going to lay them out we'll figure out what their value is, and that's also discussed in the main course. It's a longer conversation, but we find out what their values are, and we compare that value to the level of profit they make, and we look at the dollars of value versus the dollars of profit to get to what's called a multiple. And it's just what's the value of the business per dollar of profit. So that way we can compare across companies with different dollar values of profit. And then we apply that to our company. Now, in this case, we have a range of 12 to 14 times. So what we would do is we take the 12 to 14 times multiple, and we would multiply that by whatever GUI cookies profit is to get to implied valuation ranges based on the publicly traded peers. I'm gonna stop there. Any questions on that, guys? Okay, cool. So again, let's imagine we're kind of skipping some steps here. This is also covered in the main course, but let's imagine that you went and did that analysis. You go and figure out, what this business is worth, and let's say we come up with roughly $350 to $400 million. So we're gonna use that as our second valuation range. Again, we're triangulating. There isn't a single value here, and we're gonna move to the last approach here, which is looking at past sales of similar companies. So we're going to look at a set of companies that are similar to the company that we're looking at, and figure out, what those companies' sale values imply about the value of our business. So with that said, I'm going to jump ahead. I'm going to try to not screw this up so we can do actually one poll here. Bear with me one sec. Just try to put this up here. Should just create two. Okay. So, right, I'm going to open up the poll. All right, round two. I think we got it this time. So, got a poll up here. I'm going to share the slide. Beautiful. All right. So, these are our new peers, and I'll just put it in a side screen like I was doing last time, without the answers this time. So we have peer companies that have been sold, and we're looking for, I said before, we're looking at companies that are similar in substance to GUI cookies. In this case, we're looking at companies that are similar in substance to GUI cookies, but we're looking at companies also that have a deal that kind of reflects what we're looking at in the current moment. So a similar type of deal or similar deal dynamics. So I'm going to leave it at that, actually. But what I'd love for you all to do is go back here and go to the poll and rank the top three here. So tell me what you think the top three candidates are for transaction comps or transaction comparables. Again, similar companies to GUI cookies that have been sold in the past. And we'll see what you guys come up with. So give it a shot. You should be able to scan the QR code here and vote, and let's see what you guys come up with. I'm gonna have to write these down. Looks like we're having a battle here. So sprinkle, candy. Nobody for PB cup cookie? Really? You guys don't like PB cups? So, beautiful cookie with a peanut butter cup in the middle. Okay, thank you. Sympathy vote. I appreciate it. Frosted cookies, a clear winner here, huh? Okay, so they took their PB cup vote away. I'm not sure I'm going to be able to sleep tonight now. All right, so the winners here per the group are frosted cookie, sprinkle cookie, and then candy cookie. Cool. So yep, cool. All right, so I'm going to go back to the presentation here, and I'm going to hop to the next slide. Previous slide. Technically, moved it. We're going to work through these. So we said sprinkle, candy, frosted. Make sure you get the right ones. Okay. Move my live stream back over. Cool. So we're going to work through these one by one. So first we have candy cookie. Let's look through this. So happened in 2019, fairly recent. Revenue growth, a little higher, but in the ballpark. Margins in the ballpark. This is probably a similar business, and it's a cookie company, right? So let's say that one's a good peer. Now we have Plain Cookie Co. that has a higher growth rate, lower margin, so that probably disqualifies it right there. It also happened in 2009, so right after the financial crisis, so that's probably not a great peer. Then we have Sprinkle Cookie. So 2016 here, we have 18% revenue growth. We have 55% margins. The key thing that stands out to me here is the 55% margins. This is just a different business. If you can charge that much and make such a high margin on these cookies, they must be some special kind of cookie. So we're not going to use that one. Frosted Cookie Co. So recent, similar growth rate, similar margin here. We're good there. Swirly Cookie happened fairly recently. Let's see, Swirly. Yes. Swirly. Hold on. You guys picked Sprinkle. Oh, sorry. I just realized you guys picked Sprinkle. So Sprinkle, sorry, just step back. I was thinking you picked Swirly. Sprinkle, we're going to disqualify that because Sprinkle, if you look at it, it was recent, a little higher growth rate, but the margin's the big thing. So stepping back for just a second, imagine the example I often use in my classes is an iPhone. Like if I sold you if I sold this group an iPhone tomorrow, if I made my own iPhone and sold it to you, I think we'd all probably agree that you wouldn't pay the same price for that iPhone relative to Apple's iPhone. And that's because Apple can extract a higher price and ultimately a higher margin. Now there's a lot more to margin than that, but at a very high level, I'd like you to start with thinking about it that way, which is like, is this more valuable to the customer in the end or not? And if it's more valuable, they're going to pay more if they're selling the same product. And so Sprinkle, if they're a cookie company and they have that kind of margin, they probably have something special going on. So not the best comp. Sorry, I didn't realize you guys had voted for Sprinkle. Swirly, similar. Swirly, very similar business. And then PB Cup, similar business, but way back in 2012, probably not the right business. So we're going to go with Candy, Frosted, and Swirly here. And we're going to lay them out again, just like we did with the trading comparables, and we'll value the business. We'll look at the values of the business, which in this case is just sale value. You'd usually find this in a news article or some financial database. We look at the profit at the time the business was sold, and then we come up with a valuation multiple. So again, that same value relative to $1 of profit, and we'll come up with a range of values. And what we'll do is we'll say, okay, well, again, what is, Gooey Cookies profit right now, and then what's the valuation that's implied based on multiplying Gooey Cookies profit by these multiples, and you come up with a range. One thing to note while we're here is that you'll see that these valuation multiples are higher than what we saw with the trading multiples, and that's a key point again to take away more for interviews, which is that when you buy an entire business, you often have to pay more. It's called a control premium, and that's what's being captured in these higher multiples. So common interview question is, what's going to be a higher valuation, trading or precedent transaction? The answer is precedent transaction, because you have to pay more to control a business as opposed to buying part of a business. To put that in real life context, if I go buy a share of Google today, I have no control over the business. If I bought 100% of Google tomorrow, if I had trillions of dollars, I would have control over the business, and there's value to that. So when you buy a whole business, there's usually a higher multiple and a higher valuation. So that wraps up our third valuation approach here, which is precedent transaction multiples. And that in this case, that spits out 400 to 460. Again, we're going to round a value. And ultimately, step back here for a second. That's how we value businesses. What we do is we look at the cash flow valuation, which, by the way, is also called the intrinsic valuation. So the intrinsic valuation is, what is the underlying root cash flow value? And then we look at what are called they call it relative valuation, relative analysis, or multiple-based analysis, or sometimes market-based analysis. But the latter two are really based on, what other people think it's worth as opposed to the core intrinsic value. So intrinsic value, discounted cash flows, multiple-based, relative, whatever term you want to use for trading and precedent comps. We look at all three of these together and ultimately try to arrive at what we think the business is worth, which we'll talk about more on the next slide. Now, this next point is really geared toward the banking folks. This is sort of the thing I wish people had explained to me when I first started in banking, which is the whole goal of banking for M&A is usually to buy or sell a business, right? You're either representing the seller, you're representing the buyer. And the exercise that we just did here is a core exercise in banking where a client comes to a bank and says, I want to sell my business, just like we saw here. And the question then is like, okay, what's the business worth? And we go through all the exercises that you just saw. And what that arrives at is the ranges of valuation, which is presented on a chart, which is called a football field. And that's what you see here. So we lay out the discounted cash flow analysis valuation range, the trading comparables range, and the transaction comparables range, and ultimately determine what the value of the business is based on these ranges of valuation. Now, there's another term you'll hear in the finance world, particularly in the M&A area, which is that valuation is an art and a science. The science is the mechanics. That's actually what we're talking about in this last few slides. Like, how do you mechanically come up with the numbers? But the art, and I prefer the term judgment as opposed to art, the art or the judgment is like, how do we know what the right value is? And depending on the company, depending on the situation, you might have companies that are worth, maybe sell for a lot because they're super in demand, but the public markets aren't as patient with those businesses because they're not making much money right now, let's say. And that happens a lot. And so depending on the situation, the value that you'll choose is ultimately a judgment call around, what the current situation is. And that's the part that takes iteration. The art part takes some iteration and takes, years to figure out. But what you do is you take these valuation ranges and lay them out and ultimately arrive at what you think the business is worth. And the you is usually the more senior folks to start with. Here, we're just going to assume that we're going to take the average just to keep it simple. But this is how you lay out valuation in investment banking. And you would then go back to the client and say, hey, I think, in this case, we'll keep it simple and use the average. I think your business is worth $390 million. And the way we did that was we worked through, what are the cash flows worth? We looked at what are publicly traded peers worth, and then we looked at transaction comparables. We looked at how similar companies have been valued when they were sold in the past, and that's ultimately the presentation to the client. So that's in a nutshell, really how you value any business is really these three valuation methods. There are other approaches, which we can dive into maybe another session, but these are the three core ones that you'll see in interviews and you'll come across quite a bit. So with that said, there are a few things to cover before we wrap up here. The first thing is just a quick recap. So at the end of any section that we go through, whether here or in our courses, we want to quickly recap and just really make sure we solidify the information. So when we value businesses, it's either asset value or cash flow value. Cash flow value is also called the intrinsic value. And we usually go with the greater of the two, which is usually cash flow value. So in a sense, again, cash flow is the root of valuation. There are three methods which we discussed: discounted cash flows, trading comparables, and precedent transaction comparables. I won't rehash those because I went through those quite a bit. I don't want to beat the horse too dead. And ultimately, we look at those valuation approaches and come up with the... So Aiden's asking, the company is worth $401 million. Let me just back up for 1 sec. The answer is there's a little bit of blue here. When you run the numbers, it comes up to 398. And it's like harder to see with this chart, but it's just before the 400. So it's 390s. When you run the actual math, which is in the main course, you'll see it comes up to 390. So hopefully that clarifies that. So we triangulate to the values. And then the last thing to note, and I'm happy to answer any questions, by the way, didn't want to cut you off, and I'll come back to any questions you guys have. At the end of each section, particularly for our concepts series, the core courses that we're releasing now, we go through interview questions. So we want to make sure you understand how everything we just discussed ties to interviews. So the first question that is a very common question, as I said, in interviews in investment banking is, what are the three main methods of valuation, which we covered? What's the idea behind a discounted cash flow analysis? So a lot of folks can spit out, the mechanics and the names, but really understanding the substance and the content is the second question you usually get. You really want to understand that and be able to articulate that in plain English. What's trading comparables analysis? So what does that look like? So why are we doing this? What's the idea? Again, the idea as much as the methodology. Precedent transactions as well. And those are the core questions that I would want you to be able to answer after you finish this section for an interview. So that is the end of this. I got it under an hour. So that is the end of this particular presentation. I guess there are two things to note. First of all, two things beyond. Thank you. Thank you guys. It seems like there are a bunch of folks here. So thank you guys for tuning in and checking this out. As I said, we are, I'm going to be doing quite a bit of these. So I'm trying to do them weekly. We'll do some teach-ins. We'll do some chats with folks in the industry, help you guys learn more about this world. It's a really fascinating world. Finance is a really interesting place, and I'd love to share everything I know with you guys through these sessions. Also planning to do some office hours as well. And I think that's that. Beyond that, I'm just going to try this because I'll see if there are any questions here. And if not, what I'm going to do, because I thought I could do this here, but it doesn't seem like I can, is I'm going to copy a Zoom link into the Restream. And, can't post messages to. All right, I'm going to try to post a Zoom link. You can do that. Bear with me 1 second. Let me see if I can do this. I'm happy to hop on and chat with you guys if you have any other questions. I thought I could do that here, but it's not letting me. 1 sec. Other way, I really appreciate it. I really appreciate you guys tuning in. I'm going to try to drop the Zoom link in here. If I can't, I will actually. There we go. That's the Zoom link. I'm going to be hopping on there in like a minute. I'll stay here for just a second in case there are any other questions. And if not, I'll hop in there. Happy to answer questions you guys have. Again, sorry, I thought I could do that here, but doesn't seem like that's possible. So going to be hopping over to Zoom. So thank you guys. And I will hopefully see many of you soon. Okay, take care.